feeling like you need a quick but still thorough understanding of a company's potential, maybe without getting bogged down in pages and pages of reports.
Then you're definitely in the right place.
Yeah, today we're diving deep into SBFC Finance. They're a non-banking financial company, an NBFC, based in India.
And to get under the hood, we're looking at insights from a couple of key sources. There's an ICICI Securities report that's dated April 28th, 2025.
Okay.
And we also have a fundamental analysis and outlook report specifically on SBFC Finance.
Right. So our mission for you today is really to pull out the most crucial bits about SBFC's recent performance, where they might be heading, looking for those aha moments, but keeping it easy to follow.
Sounds good.
Okay, so let's start unpacking this. How have they been doing lately, say Q4 of fiscal 25?
Well, the performance in Q4 FY25, it really shows they're keeping up the momentum. The ICICI report flags this as their 8th straight quarter of pretty solid financial results and effective execution.
8 straight quarters,
Yep.
wow.
Yeah, that kind of consistency, it often signals a well-run ship.
Definitely catches the eye.
Yeah.
And it seems that their growth recently, it actually beat what they were guiding for.
That's right. Their assets under management, the AUM, that's the total loan book they manage, it grew faster than the 5 to 7% quarter-on-quarter range they'd projected. By the end of March 2025, their AUM actually hit INR 8,747 crore. So, quite significant.
That is a big number. Suggests pretty strong demand for what they offer.
It does. And it's not just about size. It seems they're getting more efficient, too.
How so?
Their operating efficiencies improved quite a bit.
Yeah.
The OPEX to AUM ratio, basically running costs versus the size of their loan book, it came down to 4.65% in FY25.
Okay, it's down from
5.34% in FY24. So a lower ratio means they're managing costs better as they grow. That's a good sign for scalability.
Yeah, that's the kind of efficiency that really flows through to the bottom line. What about the loans themselves, the quality? Are people paying back on time?
Overall, asset quality looks pretty stable. Their gross non-performing loans, GNPLs, those are ones significantly behind on payments. They were at 2.74% at the end of Q4 FY25.
And how does that compare?
It's just a tiny tick up from 2.7% the previous quarter, so relatively steady there.
Okay, stable enough.
Yeah.
And I assume this solid performance is boosting their profitability.
Yes, definitely seeing an upward trend there. Their return on equity, the ROE, how much profit they make from shareholder money, was about 13.1% in Q4 FY25. Which is up around 200 basis points. That's 2 percentage points since Q4 of FY23. Quite a nice improvement.
That's a good jump.
And they seem on track to hit their target of around 15% ROE by Q4 of FY26. So yeah, profitability is moving in the right direction, shows they're using capital more effectively.
Encouraging. But I think the ICICI report mentioned one thing to keep an eye on, something about loans just starting to show signs of trouble.
Yes, the 1+ days past due, or DPD, that did increase. It went up to around 7% in Q4 FY25.
And that's up from
6.5% in Q3 and 5.6% a year ago in Q4 FY24. So it's a noticeable rise in those early delinquencies.
Okay, so that's definitely something to watch, a potential flag.
It is. It raises a question about near-term asset quality, for sure.
But management isn't sounding the alarm bells just yet.
Not overtly, no. They express confidence, despite that uptick, that they can maintain their credit cost guidance.
Interesting. So even with what everyone acknowledges are trickier conditions, tighter liquidity, maybe more issues in unsecured loans, SBFC's leadership feels pretty good.
Their confidence stands out, yeah. Especially because, as the ICICI report notes, many other NBFCs actually trimmed their growth outlook for FY25.
But SBFC didn't.
No, SBFC delivered strong growth, 28% year-on-year AUM growth, actually, and kept their credit cost below 1% in FY25. It suggests some resilience in how they operate.
And it sounds like they're actively tweaking things, too, to manage risk.
Exactly. They've tightened up their underwriting standards. Things like lowering the FOIR, that's the fixed obligation to income ratio.
Right. How much of your income goes to existing debts?
Precisely. And also lowering loan-to-value ratios, LTVs, especially for customer segments where they might be seeing a bit more stress. It's a more cautious lending approach.
Makes sense. Sort of shoring up the defenses. And they feel their recent lending has been prudent enough.
They believe so. They think the more careful lending they've done over the last, say, 6 to 9 months should help keep asset quality steady going forward.
And to keep the growth engine running, are they expanding their reach?
Yes, that's a key part. They've been growing their distribution network, helps them hit that near-term target of 5-7% quarterly growth.
How big is the network now?
The fundamental analysis report mentioned 205 branches spread across 16 states and 2 union territories, so quite wide coverage.
And in terms of what they're selling, are they adding new loan types?
Doesn't look like it. The strategy seems focused on scaling up what they already do well, mainly gold loans.
Which are a decent chunk of the book, right?
Yeah, about 17% of AUM as of March 2025. And also small ticket loan against property, or LAP. They've explicitly said no plans for new lending products right now.
Okay, sticking to their knitting, so to speak, let's dig a bit more into the financials than the overall health and what analysts are projecting.
Sure. Well, looking back over the last 10 quarters, they've shown pretty steady average quarterly growth, around 7%, and average credit cost has been about 90 basis points.
Okay.
In Q4 FY25 specifically, revenue got a bit of a lift from expanding spreads, about 3 basis points quarter on quarter.
And that was driven by?
Asset yields ticked up to 17.8%, while their borrowing costs stayed stable at 9.33%. So earning a bit more on loans, cost of funds steady, that helps the margin.
Yeah, always a good dynamic. And we touched on efficiency earlier. Looks like overheads are being managed well, too.
Absolute. Cost-to-income ratio keeps improving. It was down to 40% in Q4 FY25.
Compared to?
42% the year before, and even better, 50% back in Q4 FY23. So a clear trend of improving productivity.
That's quite a drop over 2 years. And that other efficiency metric, OPEX to average AUM.
That also fell nicely, down 72 basis points year on year to 4.62% for FY25.
What's driving that improvement?
2 main things, it seems. One, higher average AUM per branch. They're handling more business per location. It hit INR 427 million in Q4 FY25, up from 373 million the year before.
Okay.
And second, a higher percentage of their branches are now mature older than 12 months, about 86% now versus 78% a year ago. Older branches tend to be more efficient.
Right, they've hit their stride. So more business through more seasoned branches equals better efficiency. Makes sense. What are the big targets going forward?
Well, a key one is crossing the INR 100 billion mark in AUM during FY26.
So hitting 10,000 crore rupees.
Exactly. And they also expect average monthly disbursements, the amount they're lending out each month, to pick up from around INR 2.55 billion in Q4 FY25 to maybe INR 3 billion by the end of FY26.
Suggests they expect lending to accelerate somewhat. What about profitability forecasts, return on assets?
They see ROA hovering between 4.00% and 4.50% over the next year or so.
And looking further out, say FY27, what are analysts like Mirae Asset Sharekhan projecting?
Mirae Asset Sharekhan is forecasting pretty robust growth. They're projecting a 27% compound annual growth rate, CAGR, for AUM.
Wow.
And a 25% CAGR for profit after tax, or PAT, over the period FY25 to FY27.
Those are some strong growth numbers. Any specific figures for income and profit?
Yeah, for net interest income, Mirae projects INR 987 crore for FY26, and then INR 1,253 crore for FY27.
Okay.
And for PAT, their numbers are INR 426 crore for FY26 and INR 539 crore for FY27. Just to note that FY26 PAT figure is slightly different from the ICICI reports number.
Right, which just reminds us these are estimates. They can vary a bit between analysts.
Exactly.
What about ROE based on these future earnings? What are the multiples looking like?
And how is the stock valued based on these future earnings? What are the multiples looking like? According to the fundamental analysis, the projected price-to-earnings ratio for FY26 is around 25.5 times. And the price-to-book ratio for FY26 is about 3.0 times. Gives you a sense of the market valuation relative to earnings and book value.
Okay, good context on valuation. Let's circle back quickly to asset quality. You mentioned collections dipped just slightly.
Yeah, a marginal dip in Q4 FY25. Collection efficiency was 97.74%, down just a touch from 97.88% the previous quarter.
But still within their usual range.
Correct. Still within that long-term average band of 97% to 98%, so not a major deviation.
And it seems they're also being more proactive about setting money aside for potential losses.
They are. The provision coverage ratio, PCR, how much of their bad loans are covered by provisions, that increased 46% in Q4 FY25.
Up from
40% in Q3, so they're building a bigger cushion. But despite adding more provisions, their overall credit costs stayed steady at 1%.
So preparing for potential issues without it hurting their costs too much yet. Now, that 1+ DPD increase you mentioned, it was linked to a specific region.
That's what management indicated, yes. The rise to 7.1% in Q4 FY25 was apparently driven largely by some issues in Karnataka, where they have a substantial portfolio.
And they expect that to settle down.
They expect it to stabilize over the next couple of quarters.
What about other big areas? Any similar concerns?
Well, their exposure in Tamil Nadu, for example, is only about 3% of their total AUM, so that's seen as less of a concern right now.
Okay, so the overall expectation is that gross NPAs stay sort of range-bound and they keep PCR healthy. What's their target for credit costs going forward?
They're aiming to keep credit costs between 90 and 110 basis points, so 0.9% to 1.1%.
Got it. Okay, let's pivot to their strategic focus. Gold loans are clearly important. What's the plan there?
They intend to keep gold loans making up about 15 to 20% of the total book. An interesting point is their current LTV on gold loans is around 50%.
And why is that significant?
Because it already aligns with draft RBI guidelines, so even if those new rules come in, they don't expect any major operational impact. Seems like good foresight.
Definitely helps to be ahead of potential regulation. Are they still growing that gold loan business?
Oh, yeah. They offer it from 165 branches now, and the gold loan book grew over 40%.
Wow, 40%. What drove that?
It was a mix. About 15% from higher volumes, just doing more loans, and about 25% came from the increase in gold prices, raising the value of the collateral.
Right, makes sense. What about their other main area, MSME loans? Are the returns, the yields expected to change much?
They expect MSME yields to be broadly stable, pretty much where they are now.
And it sounds like they're pretty careful about managing interest rate risk.
Very much so. They highlighted they don't really take interest rate risk because almost everything is floating rate. Both their assets, the loans they make, and about 99% of their liabilities, their borrowings.
So if rates go up or down, it affects both sides,
Yeah.
somewhat balancing out.
That's the idea. They're also looking to diversify their borrowing mix, maybe bringing in development financial institutions, DFIs.
And their target customer. It's quite specific, isn't it?
It is. They focus on the small ticket formal segment. So entrepreneurs, small business owners, self-employed folks, typically in tier 2 and 3 cities.
People who might not have perfect paperwork.
Often, yeah. They might lack formal income documents, but usually have good credit histories. SDFC estimates this whole addressable market is huge, maybe Oris 22 trillion.
That's a massive potential pool.
Yeah.
Okay, but no investment is without risk. What are the main potential headwinds or dangers highlighted in the reports?
Well, a few key ones. One is simply if their AUM growth slows down, falls below that 5-7% quarterly guidance, that would be a concern.
Makes sense. What else?
Another is if those stage 3 assets, the seriously delinquent loans, start to rise persistently, that could force them to change their credit cost guidance, which wouldn't be ideal.
Right, higher loan losses, any external factors.
Yeah, potential margin pressure. If interest rates rise sharply or their own funding costs go up significantly, that could squeeze profitability.
And operational risks.
Always a factor when you're scaling. Challenges in executing well across all those branches, maintaining asset quality consistently as they grow. And, there's just inherently higher credit risk with small ticket loans, especially in these sometimes underserved markets.
All very important points to keep in mind. Okay, let's wrap up with how analysts are valuing SBFC and the overall outlook. What are the price targets?
ICICI Securities has a BUY rating. They've actually raised their target price to INR 125, up from INR 115 previously.
And how are they getting to that number?
They're valuing the stock at 3.5 times its projected book value per share for September 2026. Previously, they used a higher multiple, 4 times, but on an earlier time frame, SEP 25 book value.
Okay, so adjusted multiple but higher target. What about Mare Asset Shuriken?
Also positive, they have a target price of Rs 130. From the current price around Rs 102, that suggests about a 27% potential upside.
And their valuation basis?
They're valuing SBFC at 3.4 times its estimated FY27 book value.
So both brokers see upside, using slightly different timeframes, but similar price-to-book multiples, roughly. They feel the valuation is fair, given the prospects.
Generally, yes. They seem to view the valuation as reasonable, considering the projected growth, the improving ROE trajectory, and the broadly stable asset quality picture.
Okay, great. So to try and summarize our deep dive here, SBFC Finance looks like a company showing steady growth, getting more efficient, and managing asset quality reasonably well, even in a challenging environment. Projections are positive, but there are definitely risks to watch, especially that uptick in the 1+ DPD.
Absolutely. And maybe a final thought for you, the listener, to chew on. Considering SBFC's focus on this specific niche market and their growth ambitions, what could that mean for broader financial inclusion in India? And also, how might bigger economic shifts, macroeconomic changes, further impact NBFCs like SBFC that operate in these particular segments?
Some really good questions to ponder. We hope this deep dive gave you some valuable insights to consider as part of your own understanding of the financial landscape. Feel free, of course, to dig into those source reports yourself or explore related topics. Thanks for joining us for this deep dive.